Hey everyone, and welcome to Cash Out. If you follow me on TikTok, you know by now that Cash Out is going to be my weekly TV show where I talk about what happened in the week prior and what might be happening in the week next. I don't know how to say that. In the previous week, in the next week, whatever, you get the idea. I'm going to be talking about that, and I'm going to be answering some of your questions. Now, the reason I'm going to be answering some of your questions here on TikTok and not on, here on start this whole video over. Hey everyone, and welcome to Cash Out. So I'm going to be answering your most burning questions here on YouTube instead of on TikTok. Reason being, for the really, really good questions, sometimes you need more than 60 seconds. So I'm going to be doing them here on Cash Out. That's why you should be following and hitting the like and the subscribe and the bell and all that stuff so you can see your questions get answered here with more depth and longer explanation to maybe make it a little less rushed and a little clearer to understand. So we have two big stories coming out of last week, Airbnb and DoorDash. I've got my notes here, so you're going to be seeing me doing this because I don't have a teleprompter, because I'm not big time. I wanted to talk about these two stocks, and I wanted to address something that was being asked of me a lot on TikTok. I noticed a lot of people on TikTok were writing me and saying, hey, I heard that DoorDash was going to go public at 80, so I put in a buy order at 80, and then I went about my day, and I came home and I didn't have any DoorDash stock. What the hell? What happened? First, to understand how these IPOs work, the way this whole thing works is, let's go back several years and say that you have a company that's been around for a while, and you're making some money, and you're doing some stuff, and you want more money. You want more money because you want research and development, or you want more money because you have a new product that you want to launch and you need the capital, or you want to make an acquisition, or you have a long-term vision for your company and you realize that you need to start planning for that vision now, and part of that is having cash. You can do something called an initial public offering. IPO just means that you get together with something called an underwriter. That's usually a bank like JP Morgan or Goldman Sachs, and you sit down with them, you go over your finances, and you determine how many shares you want to sell to the public, keeping in mind that you've already got shares as a private company, shares for yourself, shares for your employees, but now you're going public and you want to sell a certain allotment, a certain amount of stock to the public that's going to give you some money. The way this all works is the very first time you go public, that's the money you get. Once you have sold those shares and the stock price goes up or the stock price goes down, the company isn't making money off of that anymore. Maybe the executives are profiting, or hopefully not losing. Hopefully they're profiting, and the employees as well. But once they've sold those first block of shares, that's it for the company. If the stock goes up huge, the company isn't making money. The only way the company makes money off of selling shares to the public is through the very first time they go public with their IPO, and then later on down the road if they want to do something called a secondary offering. Secondary offerings usually bring the stock price down a little bit because it's seen as troubling, right? Like maybe I want to make an acquisition. That's good. So I'm selling more shares to get some money to make an acquisition. Maybe though I've got debt and I want to pay off my debts. That's bad. Or maybe there's a lot of maybes. Some of them are good, some of them are bad. They always usually bring the stock down as a short-term reaction, which if you're a savvy investor and you can read through and see what's going on, maybe it's a buying opportunity or maybe it's not. Now, with DoorDash, with these two IPOs, let's start with DoorDash first. DoorDash was going to be selling 33 million shares to the public, and they had priced it in at $80 a share, which would pull them in about $3.3 billion had they stuck to their plan. Now, a lot of people saw $80 a share and they were like, I've got $80 or I've got 8,000 or 800 or whatever. I've got some amount of money. I want to buy some amount of shares in DoorDash because I like the company. Oh, they're going to be opening at 80? Great. I'll just put in a buy order at $80 a share and I'm going to go about my day. Here's what you need to understand about the day of the IPO. The day of the IPO, the underwriters, the executives, they come together and they start really like going over everything and seeing who wants to buy, who wants to sell, if they can get more money. If they can get more money for the shares, they'll raise the price. There's usually, pre-COVID, there's a guy who's standing down on the floor at CNBC. His name is Bill something. I can never remember his name. And Bill is down there on the floor giving live updates. So usually stocks go public around 11:30 or noon. But as more demand comes in for the stock, the underwriters, the executives, they say, hey, maybe we can raise the price a little bit. I know we said 80, but let's see if we can push it to 90, get another couple $100 million or another whatever amount of money out of this. And the banks obviously also have some skin in the game because they're owning these shares as well. So their motivation is to drive up the stock price even higher because they want to walk away with big profits too. Now, here's something else about this. It's called lockup. And these executives, they can't always sell their shares, underwriters, the executives, they can't always sell their shares right away. They're stuck into something called lockup, which can be 90 days, 180 days. It's usually something like that. And at that lockup, they're now able to sell their shares. And so you'll see 180 days after an IPO, everyone's talking about, oh, the lockup is expiring today for this company. And the stock usually pulls back because you got to consider that these people are selling millions potentially of shares, millions of shares. If they really like the company though, and they think it has long-term potential, maybe they're not going to sell as much, but it still is something you want to pay attention to. Now, if you think you're going to get a lower price when the lockup expires, you have to consider that that's 180 days. That stock price could move even higher and higher and higher. And then when lockup comes, it might pull back a little bit, but it might not go down below its IPO price, right? So if you want to get into these stocks, the day of the IPO is incredibly volatile, right? So if you wake up and you see that it's opening at 80 and you put in an order at 80 and you go about your day, you're missing out on that whole afternoon where they're trying to squeeze more money, milk more money out of that stock so they can get more money for the company, for the executives, for the banks. So what happens is they keep raising the price and they keep delaying it. And one thing you'll notice if you're watching these in real time is as they delay and delay and delay and they raise the price more and more and more, it'll go from say 80 to 100 to 120 to, oh, but now it's 140. Oh my God, this is crazy. Oh wait, 160? You kidding me? And as they start getting closer and closer to going public and agreeing on a final price, you'll notice that the stock, they get closer on a price. The stock has like some odd number, right? It's like a 182.25. And when the dollars and cents start getting added, when the cents start coming in, you know they're really close. So if you're watching it in real time and you hear $182.25, that's when you want to start paying attention. Now, one thing you definitely don't want to do is put a market order in. So if you wake up and you go, just give me the stock at whatever, and then you go about your day, you could get really hurt or wiped out, right? If you have a sizable amount of cash in your account and you say, I just want the stock at any price, just give it to me because you're expecting it to be at 80. And then their final opening price is 182 and you're buying 100 shares, you were expecting to be out at 8,000. And when you come home, you're out at 18 grand. That can be very risky. So you never want to do that. So if it's the day of an IPO and you really want to get in on that company, it's best that you're there and you're watching. Now you also need to understand that right at the open, these stocks skyrocket and they sell and they skyrocket and they sell. And it's like a yo-yo. It's very hard there's no way to predict what's going to happen here. So what I like on days of the IPO is if it's a company that I really, really believe in and I really, really like, you can scale in a little when the stock starts to drop. You can buy right at the open. It's your money. You can do whatever you want. I'm not a licensed financial advisor or broker, so I can't tell you personally what to do. But I know a lot of people feel it in their bones that this is going to be a big winner stock and they don't want to miss out. So they want to get at that first opening price. Problem is, that first opening price is going to be up and down and up and down. And then in the days that follow, it might pull back a little and the hype will die down and people who bought in will sell and take for profits and stuff like that. So you have to just calm down. If you get it at 140 or 153 or whatever the prices are, if your plan is to hold it long term, you should be okay. Now, I also have seen a lot of people asking me, how can I get on that IPO ahead of the IPO? You need to be an accredited investor, which means that you need to have a net worth of around $2 million and you need to have an annual income of $200,000. And then you would have to go and you would have to talk to someone in a bank and say, I want to be getting in on these IPOs ahead of time and here's how much money I have and I'm an accredited investor. You have to become an accredited investor. And so that's how you buy them ahead of time. Or, where you work for the company and they give you shares along the way with the hope of one day going public. So with DoorDash, they were going to open at 80 and they ended up opening at 182. They were going to make about $3.3 billion. They ended up walking away with $5.6 billion. But they also ended up walking away with a lot of people talking shit about them, right? Because it's DoorDash. They've got Grubhub. They've got Uber Eats. They've got Postmates. They've got a lot of competitors and it's relatively easy You know, in the grand scheme of things, like, it's just a delivery service. There's a lot of delivery. I mean, you don't even need to use these apps half the time. You can just call the restaurant directly and say, "Can I order for delivery?" They have their own delivery drivers. So, you know, and the prices will probably be cheaper too, because they're upcharging on these apps because they have to pay the app money. So DoorDash, they ended up looking incredibly greedy and walking away with billions and billions of dollars, and a lot of executives became billionaires like that. Like the day of the IPO, they were insta billionaires. You have to look at it and say, how is this company that's only been in existence for a little bit worth $55 billion? You know, they're worth more than some other established long-term companies, and they have nothing really there. Like, their revenues are whatever. And when you look at DoorDash right now in this moment, it's COVID. They're probably never going to have it this good again, right? Nobody's going to restaurants. Nobody's going out. Everyone's socially distancing, hopefully. Nobody's really going to restaurants. And if you are, it's at limited capacity and it's outside and it's winter, it's going to be cold. DoorDash is going to crush. If DoorDash has been around for 10 years prior to this would probably be their best quarter ever and the stock would be flying. So that's another concern of mine, is that they're going public at the best time possible for their company. And then what? We get a vaccine, COVID goes away, restaurants reopen, people start going out to restaurants again, and all of a sudden, nobody's really ordering from DoorDash. So I would have some reservations at DoorDash. Now, next day was Airbnb. Airbnb is a little bit of a different story. They've only got one major competitor, which is VRBO or Verbo or whatever. And then, of course, they have hotels, but some people really hate hotels, whatever. And on top of that, Airbnb is a global company. DoorDash, as far as I know, DoorDash is just here in the States and maybe, I don't know. Airbnb is everywhere. I can go to Mexico, I can go to China, I can go to Taiwan, I can go to Thailand, I can go to somewhere in Africa, and I can get an Airbnb. I used Airbnb when I went to Cuba a couple years ago. So, you know, you can see that they're a much larger company that has much more potential too, right? They could get into the hotel business, they could expand, they could grow, they could do other kinds of rental things down the road. They maybe could acquire some small hotel chain. You know, they could do a lot of things. Airbnb, similarly, was going to open at $40 to $50 a share. Ended up opening at 146. There was demand. The stock closed down on Friday. Airbnb opened at 146 and shot up to 165. If you're at your computer and you can hop in on these things, like I personally did, a very quick trade, in, out. I bought back in later as it dropped because I like Airbnb and I believe in it long term. But I also am aware that these IPOs are volatile. They go up, they go down, they swing. They're very, you know, they're very reactive. I said reactionary once, and that was the wrong word. They're very reactive. They get pummeled. They sell off. They have, you know, bad news. Economic stuff obviously is a factor. Also with Airbnb, you have a lot of people who aren't really necessarily traveling, but they can work from home. And now anywhere can be home. That's a great selling feature for people who want to say, like, I'm going to go to Wyoming for a month, and I'm going to stay in an Airbnb because I can work from home, and my home can be anywhere. Like that Metallica song, Wherever I May Roam, should be Airbnb's theme song. So I like Airbnb, and I want to share a personal IPO story with you to say, like, don't get so caught up in the moment, because if you're investing in these stocks for the long term and you really truly believe in them, you know, you believe hopefully that these companies will go up. So when I was younger, I used Facebook, and I still use Facebook. But when they started to announce that they were going to be going public, I didn't really know much about this IPO stuff and how much market cap and how much are they going to make and yada yada. All I knew was I use this website. I like this website. Everybody that I know is on this website. I'm going to buy stock in this company. And I bought it on the day of the IPO, which I believe was in 2008 and was around, you know, in the 30s. And right after the IPO, a couple weeks later, the stock crashed, went down into the 20s, and I loaded up. I bought even more. And I've held that stock ever since. I started selling off within this last year because of some, you know, they're going to be sued, and there's some other stuff like that. And I wanted the profits because I bought this apartment, so I needed some of that money to do that. But, it's a long-term strategy. So when I sit here and I say don't worry so much about the in the moment on the IPO day, when I bought Facebook, I bought it on the IPO. I don't even remember what I paid. I know it was in the 30s. I bought more in the 20s. I don't really care what I paid because look where it is now. It's in the 270s, 280s. So I'm pretty happy with that. So we had these two monster IPOs, and the next question is, what's the difference between an IPO and a SPAC, or a special purpose acquisition company? An IPO takes time. It takes several years to get everything in order, work with the banks, figure out what the company's worth, all that stuff. A SPAC is a little bit different because it's a hedge fund or it's a very rich investor who takes a company public, like a holding company. It's just a shell. There's no company there yet. They're looking to acquire a private company. So instead of my company going public through an IPO, which can cost me, the company can cost me money, it can take many years. If I have a privately owned company and I want to go public, but I don't want to go through that route, I can find a very rich investor, like a Bill Ackman or someone like that, and I can say, hello, I've got this company, here's what we're worth, here's our vision for the future, here's what we're working on, what do you think? And if he thinks it's a viable company, he'll acquire it, essentially. He'll put it into his holding company and rename it whatever my stock is. So you would have seen that with Fisker. I can't remember what their original symbol was, but it was like some 4-letter ticker symbol, and now it's FSR. So it changes. The guys who owned the special purpose acquisition company get a place on the board. Obviously, they get some shares too, and it goes public, and there's a lot of hype around that. So that's kind of the difference between a SPAC and an IPO. Now I want to get into some of your questions, and I will tag you on TikTok to let you know that this video is up, because I'm trying to get Cash Out to be around a 20-minute show, and I'm almost at 18 minutes. One person on TikTok asked, how many shares do you buy? And the answer to that is it depends on what I'm buying. And it depends on what my purpose is with the stock. If it's an investment, buy as many shares as I can afford. If I really believe in the company, if we're talking about something like Amazon or Tesla, I'm buying a share at a time. You know what I'm saying? If it's something like Apple, I buy in blocks of 10 or more. It depends on the price, depends on the goal. So let's go in reverse. If I'm trading the stock, if it's a penny stock, for example, something under $5 a share, I usually buy in blocks of 1,000. Obviously, if the stock is lower, if the stock is $2 a share, for example, I'll buy 2,000 shares. I'm looking for very quick trades, and I'm looking for the stock to have a lot of volume, a stock that moves a lot. So I'm not just buying random penny stocks and just hoping for the best. I'm buying penny stocks that I have studied and I have watched and I've been keeping an eye on. And I know by now this stock is in a trading range. Every time it gets to 2, it goes back up to around 240 or 220 or 210, whatever. And if it's a very small trading range, 2 to 210, 2 to 210, I'm going to be buying a lot more shares because I need that small price move to be worth it for me, right? So 1,000 shares is $100. 2,000 shares is $200. 3,000 shares is $300. If it's a more expensive penny stock, something around $5, then I'm usually buying 1,000 shares or even a little bit less. If it's, and by the way, you can trade large cap stocks too. I used to trade McDonald's and Microsoft right when COVID started. I was trading them back and forth, back and forth, back and forth. And I would buy anywhere from 10 to 25 shares at a time. So it really depends. If I'm day trading or swing trading, if I'm swing trading, I'll tend to use a little bit less money and I'll buy less shares because I'm tying up money for a longer period of time, right? If I'm swing trading, it's anything more than a day, but it can be 2 days, 3 days, 3 weeks, a month. It can be longer. So I don't want to tie up a lot of money on something that I'm just kind of gradually waiting for it to move incrementally higher. I'll do a little bit less. More if it's a penny stock and it's usually going to be a 1 or 2 day kind of trade, then I can tie up a little bit more because I know within a few days I'll be getting that money back in my account, or I'll be selling for a loss. And on to the next one. Next question. Do you have more success? I think this was from that Kaylee person. Do you have more success as a day trader or as a swing trader? It depends on the year. And that's one of the things that I always talk about, where I say it's so important as a trader to have multiple methods and multiple techniques, because one year you are going to be in a relatively strong bull market. You can swing trade that shit, buy and hold for a couple of weeks and ride the wave, ride the rally, ride the momentum. Get out, buy something else. I have been trading stocks for 10 years. The last 2, I've been day trading mostly. And I say day trading, but I use that kind of loosely. I'm still swing trading. Day trading is very strict. You are in, you are out, win, lose, or draw on the same day. Start over the next day with the same amount of money. In, out, draw, close out all positions at the close. I don't do that. I'll usually hold. So I'm usually a swing trader anyway. But if I can get in and out on the same day, I think you'd be a fool to not take those profits on these very volatile penny stocks that shoot up, and then everyone goes, yeah, this stock is going to be the next Tesla. And then before you know it, it's like 3 cents. It depends on the market. It depends on what's going on, and it depends on, I guess, that individual stock. Like I said, I've been swing trading for 8 years, so I've obviously had more success as a swing trader. However, leading into the very next question, I'm asked, how was 2020 for day trading? 2020 for day trading was chef's kiss. It was the best. If you look at it like, why was it happening? Well, maybe it was the president. Maybe it was the way he was reacting on Twitter and driving the markets up and down and having tantrums, and then and no one knew what to believe with this guy. And then sometimes he would come out and say something great, and the markets would skyrocket. And then a couple days later, he would say something else, and the markets would drop. And and then this COVID thing hit, and nobody really knew what was going to happen. So it was very in and out, in and out. Although maybe you could say it was the way he handled it caused the markets to be more volatile, because he didn't really have a plan. So if you're looking at the cause of this day trading, I think it was pretty bad news. Personally, as a trader, it was great. It was great. This is my best year ever. I've been trading for 10 years. This is my best year ever. I will definitely, moving forward, be implementing more day trades into my strategy. Although I imagine now with Joe Biden, markets will be a little calmer. And that's okay, right? Day traders traded under Obama. They traded under Bush. Day traders have traded, for as long as the technology has been there to do it. And they'll continue to do it. So I will continue to swing trade if we have a slow and steady kind of churn up, which I expect we might have. If the market, and by the way, I think once the market realizes that this volatility is good for their bank account, volatility is not going away forever. I think we'll still have volatile markets, just maybe a little bit less. Next question. This is the last one. How do you know when to sell quickly versus when to hold for the long term? It depends on what your investment strategy is. And it depends on what the company is. You know to sell quickly when it's a trade. When it's a company that maybe you don't know a lot about, maybe you don't even really like, maybe you don't really even care about. You're not looking at the fundamentals. You're not looking at the revenue or their debt or their cash or if they pay a dividend or what the analysts think. If you're not looking at any of that, chances are you don't really care about the company. Chances are you're looking at the company going, I'm looking at the charts. I'm not looking at the company. I'm looking at the chart. And I see, ooh, this setup looks pretty promising today. Or I look at the 1 month chart or the 3 month chart and I go, oh yeah, there's a definite trend upwards here, but I don't really know why. I don't really care why. I just see the trend. I just see the pattern. I'm going to hop in. I'm going to trade the stock. If it starts to drop, I'll get out. If I'm looking at an investment, then it's a little bit different, right? Like if I'm buying Starbucks, I'm buying it because I believe they have a long-term plan. I look at their cash. I look at the revenue. I want to see that the revenue is increasing. If I'm doing all of that work, I'm doing it for a reason, because I plan on being in the stock for the long term, and I don't necessarily concern myself with the daily or weekly or monthly swings. Oh, maybe they had a bad quarter. Oh, the stock dropped a little. Oh, they're in trouble for some whatever reason. They're in trouble. Oh, the sales are slowing overseas. Oh, coronavirus has halted. I don't really care about any of that stuff. I'm not going to exit that position. If anything, I'm going to buy more if it gets crushed, because you have to look at it like it's a sale. It's a sale on a brand that you like. If you went into a store and they had a 25% off sale, wouldn't you buy more things, right? Like if you walked in and you were going to buy one bag of Doritos, but it was buy one, get one free. You mean to tell me you're just going to walk out with one bag of Doritos? No, you're going to get 2 or 3 or 4 bags of Doritos because it's a huge sale and you're going to eat them. So it's the same way with the stock. I know I'm in the stock for the long run. I know I believe in this company. Yes, this is bad news. Whatever the bad news is, the stock went down 25%. Everyone's freaking out, not me. I have a 10-year plan on this stock. I'm going to buy more. It's that old Warren Buffett quote, when others are greedy, be fearful. When others are fearful, be greedy. So you load up a little bit more. It just comes down to your strategy. Now, that doesn't mean that at a certain point you might not want to take some of that profit. So when do you know to sell quickly versus keep for the long term? You know to sell quickly when it's a day trade, when you don't really have any interest or real investment in the company. You know to hold for the long term when it's a company that you're buying and holding for the long term. But when do you take your profit? That's the big question. I believe in this company. I like this company, but I'm sitting up like 100 or 200 or 300% on the stock. Should I take some of that money? Of course. Of course you can. You can do whatever you want. If you need money for something, let your stock, let your investment pay for it. And I'm not saying like, oh, I really want that new PlayStation. I really want that new PS5 or the new Xbox. I'm going to sell some of my stock. You shouldn't be doing it for stuff like that. I mean, at least I personally don't think so. I think you should be using your stock like I did when I used some of that money to buy this apartment and redo my kitchen and, paint and get new furniture. Then I had to sell some stock because I wanted my investments to pay for it. I didn't want to go into my cash and deplete my cash, which I used to make investments. So I was able to sell off some investments, let that pay for my apartment, or at least partially pay for it, and move forward. So it depends on a lot of things. What's your goal with the stock? If it's a dividend paying stock or it's a growth stock, you might not want to sell it. You might not want to sell and take profits. You might have a very long-term plan, but at a certain point, something's going to happen. At a certain point, you're going to need to buy a house, or you're going to need to buy a car, or you're going to need to buy something. And you say, hey, I can sell a couple shares and buy this used Honda Civic and keep the majority of my money in this growing investment. That's a smart move. Saying I'm going to sell my Facebook to buy a brand new Porsche, probably pretty stupid, unless you've got lots and lots of money in the stock, which probably most people don't. So I said I was going to try to keep this show at around 20 minutes. It's almost 30. Next week, we didn't even get into next week. Well, I think the big news is on Monday, the electors are going to vote, and we'll know once and for all what's going to happen with the president. If they vote, to make Joe Biden the president, then I think the markets will react positively to that news because it's putting an end to all this. That's something else that Wall Street really likes. They like finality. So a lot of times you'll see a company is being sued, and the company comes out and goes, all right, we're going to pay $3 billion to the families of our plane that crashed. That seems bad, but the stock goes up. Why? Because it's over. It's over. That's why the stock goes up. Yeah, they're going to pay $3 billion. Fine. But this isn't going to be in the courts. This isn't going to be in the news. The story is done. It's over. It's the past. And I think that might also happen on Monday if Joe Biden gets the electoral votes. I think the market might just go, finally, these lawsuits and the thing with Texas and the different states, it's all over. They don't really care who wins or who loses, although I think maybe some of them probably do. What they care about is that the story is over and we can move on now. And what's next for the week? Pfizer, I guess. Pfizer is supposed to be getting emergency approval for their vaccine. I think that could be very good for the stock or for the markets in general. You might see that some of the work from home stocks sell off a little bit because all of a sudden we're going back to work tomorrow. Like, you know what I mean? It's a little bit reactive. Like I said, markets can be reactive. So I think we covered it. I think that's episode 2. That's a wrap. We're done. Please like. I didn't mean to stick my finger in your face. Please like. Please hit the bell. Please subscribe. Have a good rest of your week. And follow me on TikTok because I'm going to be there too. Thanks for watching. See you later.